Hi guys, my name is Elena Redko and I am the course coordinator for Rogers CPA Review. Since my job predominantly entails making sure that you get the most up-to-date information, I wanted to take a moment and chat with you today a little bit about our 2015 CPA exam. There is a handout that comes along with this video, and I certainly encourage you to download it and read further detail for yourself. We are going to start today with the FAIR update. There are three major parts to the FAIR update this year. One of them has to do with the revenue recognition provisions, another one has to do with the big gap versus small gap rules, and the third one has to do with understanding of the conceptual frameworks and the differences between the conceptual frameworks on the CPA exam. Let's start with the conceptual frameworks. In terms of understanding the conceptual frameworks, there are four that we will be talking about in our 2015 materials. First one is GAAP, second one is IFRS, and of course both of those frameworks fall under accrual accounting framework, or the framework that we are most familiar with in our studies for the financial accounting in general. And then there are two more frameworks, and that's the tax basis and the cash basis. Understanding the differences and the interaction of those frameworks is going to be really important on the 2015 CPA exam. Whereas accrual accounting accrues for revenues and expenses under either GAAP or IFRS, depending if you're preparing domestic or international financial statements, cash basis accrues only on, well, cash basis, and tax basis has to do with increasing our revenues and decreasing our expenses to make sure that we make the taxable income as large as possible. Well, that's a little bit of an overstatement, but if we had to go really basic, that is what is happening. So that is the first update, and we will have a relatively large chapter in our financial books to address the differences between the frameworks, since those are technically foundations for everything else that you're going to do in the financial exam. The second part of the big gap versus small gap is discussed by Mark Doberman in details in our seminar, that is our webinar, that is available on our website currently. The very bird's eye view of the big gap versus small gap is the fact that small companies were subject to the same rules as larger corporations, and it was becoming very obvious that making the small companies follow the same rules as the big companies for certain items, such as goodwill, was becoming really burdensome for the small companies. And so they were finally heard, and the new rules were developed in order to make smaller companies take a smaller burden when preparing their financial statements. Mark Doberman will talk to you more about it in our webinar on big gap versus small gap. The third and final for today discussion of the financial update has to do with revenue recognition. In 2015, the revenue recognition update is not going to be huge. However, in 2017, it will be. Here is why. For 2015, only IFRS revenue recognition rules have been updated, and therefore, it will be a much smaller theoretical update. However, in 2017, our GAAP rules will be updated. And once the GAAP revenue recognition rules are updated, that will impact a large part of the way that we do accounting. Because think about it. If we actually accrue revenue or recognize revenue in a different manner than we do today, that would impact a ton of the way that we prepare our financial statements. All right, that rounds up our financial update. Let's take a look at what's happening with audit. We're going to sort of decrease in size as we move along through the webinar. So our financial update is truly our biggest update this year. In terms of audit or auditing and attestation, there are also three updates, but they're much smaller in size. The first one has to do with additional requirements for supplementary information. The second one has to do with the use of internal auditors. And the third one, and probably the most important one, has to do with auditors' ability to now prepare financial statements and provide non-attest services. So let's talk about those. In terms of additional requirements for supplementary information, the auditor, the external auditor, now simply has to provide more information in the supplementary information to the report that he or she prepares. Pretty easy, right? And we will tell you what those additional requirements are. You'll read through them. There may be a mnemonic, there may not be a mnemonic. We will help you memorize it or understand it or both, and then we'll move on. In terms of the use of internal auditors, of course, when we come in as auditors, as external auditors on an engagement, we always ask internal auditors or controllers for information because we have to run tests, we have to see if their quality control is in place, etc., etc. This update emphasizes that no matter if we're getting our information from a bookkeeper or from a controller or from an internal auditor, it is ultimately the external auditor's responsibility to check all of the information and then use it properly to determine whether the financial statements are truthful and whether everything is properly disclosed. And then the third update has to do with the fact that now, as external auditors, we are able to provide non-attest services. We are able to help our clients prepare financial statements as long as we're not also auditing them, which makes sense, right? So that was pretty easy, and those were the two biggest updates. In terms of regulation and BEC, regulation is not going to really have a theoretical update. In terms of our theory for tax and business law, and surety and bankruptcy and all that stuff, that's all going to stay the same. There are going to be tax updates or updates to tax materials, and those will have to do with increasing percentages or certain changing to thresholds and expiration of certain provisions and tax credits. So some tax credits are going to be simply removed from the books and numbers are going to be updated. For example, the itemized deduction for medical expenses is now going to be 10% of the AGI instead of 7.5% of the AGI. So those are going to be pretty simple. All right. Last but not least is our BEC. For BEC, we are going to have one relatively large update, and that will be the Dodd-Frank Act. The Dodd-Frank Act is currently being tested somewhat in the regulation exam. It will continue being tested in the regulation exam, but it will also be now tested in the BEC exam. However, in the BEC exam, it will be tested specifically in the corporate governance section, meaning it will likely be together with the Sarbanes-Oxley Act and the 1929 Act, just to remind us that the ultimate responsibility of the accounting profession is truly to protect the public. All right? So that finishes up our 2015 update. Remember, everybody at Rogers CPA Review is truly here to help you pass, and pass in the best possible, the most efficient, the most effective, and the most enjoyable way. Thank you.